Assalamu alaikum wa rahmatullahi wa barakatuh. I want to welcome you to our educational seminar on Islamic home financing. My name is Hussam Qutb. I'm the Senior Vice President with Guidance Residential. I have been with the organization for quite some time. I would say 19, well, actually 20 years. Let's round up a little bit. I have been to many masajids around the United States. I've done such presentations to many community members, to uh, countless real estate brokerages, even at the major conventions like ISNA, ICNA, and MAS. And as I travel, I have to tell you, I see some beautiful masajids, and I'm very, very, very uh, uh, privileged to be able to see these masajids grow, and this is no exception. I mean, this one, mashallah, has grown, and the amount of masajids that I've seen grown in the Southern California area is quite impressive. The Muslim community in the Southern California territory is mashallah, um, certainly ahead of the curve. Let's just say, but but I think there's a lot more ahead of us, a lot more to do, and part of it has to do with our community engaging in home ownership, engaging in real estate ownership. And as we all know, that's the path towards generational wealth creation. And so we're going to talk a little bit about that today, but mostly we're going to talk a lot about who we are as a company. What does our program look like? How does it work? And what makes it different from conventional riba-based mortgages. Our program really is going to cover three major things. You're going to hear about us. A lot of people don't know guidance, or if they heard about guidance, they have some misconceptions. So we'll try to clarify those and give you a little background and introduce ourselves properly now, because we're introducing ourselves, not someone else. And then we're going to cover riba. We know the impermissibility of riba, but I think a lot of us don't understand truly how it is created in a transaction such as a mortgage. So we'll cover that topic, and finally, our program and how does it actually function? How does it compare to conventional riba-based mortgages? And then we'll open it up to Q&A. I will be here as late as it is necessary. I have a flight to catch in the morning, so we'll have to end it before that flight. But I'll be here as late as necessary to answer all your questions, to clarify. So we never shy away from ensuring that every aspect of our business is transparent, it's open to the public. That's our motto. It's been that way for the last 20 years. So who started guidance? How did it come about? A lot of folks ask or wonder at first, are we a mom and pop shop? Are we some small entity that, was born out of a garage, or uh, and 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 this is a common, misconception about us. But the reality is we were founded by a company called Capital Guidance. It's an international investment company. Currently, it's a private equity firm headquartered out of Washington, D.C. The founders are all Muslim founders who basically started this organization 60 years ago. They started the organization in Damascus, in the streets of Damascus, as a company that engages in trade. And slowly but surely it has grown as a global institution that uh, has extensive experience in the creation, the building, and the development and the management of very unique corporations and companies that add value wherever they are, add value to the community, to the industry, to society. Um, it essentially today it's grown to a multinational company that has 77 offices in 27 countries across the globe. And these are the operating sectors that it functions in. International financial services really is covered by us, by Guidance Financial Group, and I'll cover a lot more of that, of course, soon. And we're only about 20, 21 years old. So in the span of 60 years, we're the youngest child of the organization. Investment management, real estate, luxury home products, global industrial services. In fact, the only other company that actually operates here in the United States under capital guidance, besides us, is a company named Madison Marquette. It was established about 30 years ago, and it's a commercial real estate investment, development, and management company. And it functions in a number of states around the US. And one of the very first projects that, that essentially put Madison Marquette on the map actually happened here in Southern California. Um, you've all probably heard of Rodeo Drive. So that's the kind of the iconic shopping area. There's also Rodeo 2, and that was a property that was actually invested and developed by Madison Marquette. There are many properties like this. In fact, in our nation's capital, in Washington, D.C., the largest commercial mixed-use, high-end commercial real estate project right on the water called the Wharf, and and Wharf 1 and Wharf 2, which just completed recently. That's also a Madison Marquette project. So there are many of these type of very iconic projects around the United States that a lot of folks don't know that were supported by the efforts of Muslim businessmen. Um, Moving forward, capital guidance through Dr. Muhammad Hamour, who is the son of the founder of capital guidance, Dr. Abdul Ghafoor Hamour. He is really the mind behind Guidance Financial Group and Guidance Residential. It was his vision to work on and establish a global Islamic finance institution, one that operates at the same level as your typical blue chip companies, the standards of which are very high. The service, the entire process, the journey for the consumer, whether it's a retail consumer or institutional investor. Dr. Muhammad Hamour has a background in economics. So as a member of Capital Guidance, he actually brought his knowledge of economics, where he taught as a visiting professor of economics at MIT, taught at Columbia University, and was also a consultant to the World Bank for some time. Um, he brought this knowledge into this landscape to make an impact. The impact today, after 20 years, is significant. You'll see some of the projects that have been rolled out, including, of course, Guidance Residential. But Guidance Residential, as a subsidiary of Guidance Financial Group, is not the only arm of this global Islamic finance institution. We also have Guidance Investments, headquartered in Kuala Lumpur, Malaysia, that handles institutional investment needs of institutional investors. We have also Guidance Home Services. Guidance Home Services is a sister company of ours here in the United States that actually works closely with real estate agents around the United States to help educate them, number one, about the needs for Muslims to buy homes in an Islamic manner, and then secondly, to actually invite them to become members of its national network, so that when we do pre-approved buyers, we can comfortably refer them to Guidance Home Services, who then connects them to a certified, licensed, pre-screened real estate agent in their neighborhood, somebody who may be working for Remax, for Keller, and some of these others. So they have 1,600 agents across the United States that have gone through this pre-screening process, just so that they can step up to the plate and help American Muslim buyers comfortably. Um, so Guidance Financial Group was created actually in 2000. And then subsequent to that, we launched Guidance Residential officially, opened our doors for business in April of 2002. In these last 2 decades, Guidance Financial Group, as our parent, has completed a number of projects: capital markets projects, investment management projects, international finance projects. This is essentially the footprint of our global Islamic finance company, Guidance Financial Group. This is some of the work and some of the accomplishments in the last 20 years. And believe me, I didn't bother to put too many because that will take up the whole night. But I put up on the screen here two major projects that you'll notice the logos on the bottom left of some major profile projects in the Middle East. In 2006, late 2005, 2006, we were in operation for about 4 or 5 years here in the United States. And remember, when we launched this, we were going into the most heavily regulated financial market in the world. To establish something completely different than what is considered a mortgage loan was an undertaking that I'll go over here in a second. But that accomplishment led to many knocking on our doors, asking us if we could be technical advisors to them in Muslim nations to help them establish similar projects. The Kingdom of Saudi Arabia came knocking, and a group of investors, along with the authorities, the Ministry of Finance, looked to us to help them establish the first standalone mortgage company in the Kingdom of Saudi. They didn't have standalone mortgage companies, let alone secondary markets like a Freddie Mac and Fannie Mae to help create liquidity to allow more Saudis to buy. They had banks, of course, but not standalone mortgage companies. So we worked very closely with them as their technical advisor. We worked very close with them also as a co-investor. And we developed a company and its program called Dar al-Tamlik. Dar al-Tamlik today is the largest and most successful standalone mortgage company in the Kingdom of Saudi. Shaza is another project that began as a way to create something that didn't exist. It was providing essentially access to institutional investors. These are folks who want to invest tens of millions of dollars at a time in major projects, one of which was kind of off the table, hospitality funds. Hospitality funds typically are not funds that you invest in as a Muslim. Why? Because the hospitality industry itself, you're looking at not just hotels, but you're looking at the sale of alcohol, pork, and potentially gambling, casinos, and such. So our chairman, Dr. Mohammed Hamour, looked at the creation of looked to have the creation of a hospitality fund that would support a concept for a five-star luxury brand hotel that operated completely under the principles of Islam, while also the concept celebrates the essence of the Islamic empire, the Silk Route, the traditions of Islam. This was a unique concept. The fund, when it launched, quickly grew in popularity, raising hundreds of millions of dollars from institutional investors that sought these kinds of halal returns. And we partnered with Kapensky Hoteliers. If you know who Kapensky Hoteliers are, they're the oldest and most distinguished hotelier company in the world to bring this concept to life. That concept was launched in 2007, 2008, with the first Shaza Hotel just outside of Medina, the Haram. So if you've gone to Umrah, if you've gone and visited Medina, you would see this hotel right outside the Haram. And if you walk through it, you'll really understand the concept, truly understand the concept, because everything from the bukhur in the hotel to the cuisine, to the architecture, to the art on the walls was all a celebration of the Islamic traditions. And today there are more than one of these hotels. There's one in Salalah, there's another one in Doha, Abu Dhabi is coming on very soon. But all of that became a reality because of financial structuring that allowed for Muslims to engage, become engaged. There's one more project I'll mention in Morocco. This was interesting. The three largest banks in Morocco worked with the local government to try and convert and create Islamic financial products and services. We were one of three bidders on this project. Qatar Islamic Bank, Islamic Development Bank, and us all bid. And we ended up actually working with the second largest bank in Morocco to help them find a path towards providing Islamic financial products and services for their community members. There are many more private equity funds that we've launched internationally, but we're not here to talk about any of that tonight. We're here to talk about Islamic home financing here in the United States. So it was Guidance Financial Group, with the help of Capital Guidance, that created this concept for financing a home in the US um, in a Sharia compliant manner. Here's what it entailed. In 1999, we embarked on this project. It entailed a three-year, multi-million dollar research and development project. This entailed 18 different law firms. A lot of people see that as, oh, 18 lawyers. No, 18 law firms that specialized in the housing industry and the regulatory side of housing in the United States, from mortgages on the federal level to the state level. We even pulled in, during those 3 years, six of the world's leading Islamic financial transaction law scholars from all over, from the different madhabs and such. You'll be introduced to who these gentlemen are very shortly. But at that time, and even I would argue today, these are the most eminent scholars in Islamic financial transaction laws that our planet knows today. Um, After those 3 years, and after all the intricate ups and downs and the recommendations from bankers and recommendations from lawyers that we should maybe go an easier route, one route that was constantly recommended was, just go and get a bank charter. It'll be easier. Just go apply for a bank charter, become a bank, and your path to each state will become much, much easier. And you don't have to deal with regulations on a state by state level. Well, there was one problem with that idea, which was shot down numerous times. You, you become a bank in the United States, and based on the banking rules, there is absolutely no way to avoid riba. Period. Full stop. No way. So that for us was a closed door. We were not going to become a bank. We were never going to entertain that thought until the banking laws of the US change. And let's not hold our breath, because the bankers make the laws, they help solidify the laws so it can benefit them. And riba is the name of the game with the banks. It's just a perpetuation of more and more riba. And that's not why we entered into this space. Ultimately, we were able to develop a program called the Declining Balance Co-Ownership Program, which has a contract, which is essentially a co-ownership commitment agreement that establishes co-ownership between the two parties, something that the US had never seen before in the housing finance market. So, since our launch in 2002, this is where we are today. We were actually operational in 4 states when I joined in 2003. And today, alhamdulillah, we've served nearly 40,000 American Muslim families, some non-Muslims. We've provided $10 billion, just over $10 billion in this structured financial program. And now we operate in about 34 states around the country. I'm not going to bore you with all the history. There's a lot more details on it on our website. Feel free to dig in and find out how we got here. But one of the things that I do want to point out from this is, in 2012, up at the top, we learned from working very closely and supporting masajids and supporting Islamic schools efforts and supporting the Muslim American Society, the Islamic Society of North America, the Islamic Circle of North America, ICNA, MAS, all of your institutions that you know are the nonprofits. We learned in 2002, and when in my talks with some of the leadership of those organizations, that in those 10 years at that point, we were actually the largest corporate sponsor and supporter of American Muslim nonprofits this country has ever seen. There was no other national corporation that has given back so much. And we were just essentially moving through year over year, educating, just like we're doing tonight, but we would obviously support them as should, obviously support these nonprofits, sponsor their events, and so on and so forth. But when we got to 2012, all of that sponsorship amounted to over 1.5 million back to the community. Today, it's much more than that. But that makes a statement, and the statement really that I think we should all, walk away from seeing this is that Muslim-owned institutions ultimately support Muslim charities, Muslim-owned nonprofit organizations, masajids, Islamic schools, and helps to develop what we like to call the Muslim circular economy. Because the Muslim circular economy ends up helping all of us at once, especially if on our part, we're not only giving back and circulating funds within the community, we're actually helping Muslims establish greater wealth so they can give back as well. A renter is not going to be a donator of funds to the masjid as much as a property owner, a homeowner. And that's part of the philosophy for why, when we started in the United States, we wanted to go after and ensure that Muslims had access to home ownership first and foremost. We could have picked any other financial product to launch, but we picked the hardest. We picked the most complicated. We picked the most heavily regulated, which is the US housing industry. So over these years, we've gotten tremendous amount of attention from the conventional media, the Western media, even some Middle East media. A lot of these articles were written in 2009 through 2013. And a lot of these stories were running around that time because right after, if you guys remember, the 2008 collapse, the financial crisis, many of these folks from the New York Times to the Wall Street Journal and others came to us asking, because they heard about our launch in 2002. That was something unique. Freddie Mac and Fannie Mae, when they first approved our program for the first time, approved the purchase, the silent investor purchase of the Musharaka Mutanaqisa structure. They had said that, some amongst them have said that we were one of the most uniquely structured mortgages they've seen in the last 30 years in housing. And so a lot of these folks came back to us after the mortgage meltdown, wanting to know, did you shut down? Did you have issues? Is your Islamic quote unquote model one that withstood the turbulent times we just faced? And frankly speaking, it was quite a treat because we addressed a lot of these media inquiries with, yeah, we are still in business. In fact, 2009, the year after the collapse, we ended up having our best year in production since inception. So that goes to the principles of Islamic financial transaction laws in terms of taking on risk, but also mitigating the risk by making sure that you are truly not over leveraging, truly, when you have to take on more risk, you become a little more responsible with how you finance folks and so on and so forth. So I thought that was pretty neat. In 2014, this organization called the Assembly of Muslim Jurists of America, AMJA, conducted a full study in that year, and the group represents about, I believe it's about 350 to 400 imams around the United States. They delved deep into our program. They reviewed it, and then they reviewed other Islamic home financing programs in the US. They dedicated their convention that year to this topic. And their findings, which we were very, very pleased with, we weren't surprised, but very pleased with, was that our program was the most permissible program for American Muslims to finance homes in the United States without riba. And their conclusions were, if guidance does not or is not able to approve you, only then you may go and attempt to use the other providers, provided you are in dire need of buying a home. That's how severe this sort of proclamation that they launched with was. And there are many scholars on their board. Most of these scholars are US based, I want to add. I mentioned our board earlier. Speaking of scholars, our independent Sharia supervisory board, the members of this board that you'll meet here shortly, they've all served or currently still serve on an institution called the Accounting and Auditing Organization for Islamic Financial Institutions. This is referred to in short as IOFI. So if you've heard of IOFI, you're one of a million people or so. Not a lot of folks have heard of IOFI. But if you've worked in a central bank in an Islamic country or any financial services company in the Middle East or Asia, you've heard of IOFI. Why? Because IOFI, headquartered in Bahrain, IOFI is the official standard setter for Islamic financial institutions and central banks for setting standards that dictate how you can operate whatever it is, financial instrument, structures in an Islamic manner. And this organization has in it, besides economists and financial experts, it has its own Sharia supervisory board that oversees all of these standards. The Sharia supervisory board of IOFI is chaired by one gentleman. His name is Mufti Sheikh Muhammad Taqi Uthmani. Now, um, he has been uh, 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 labeled as one of the top 500 Muslims in the world. In fact, in one year, he was in the top 10. And I believe more recently, he made it to the top 5. This gentleman holds a lot of esteem. But for us, when we launched this organization or launched our research and development program, we not only needed to make sure that he was on board with our independent Sharia supervisory board, we wanted to make sure there was a collective of other scholars that represented other madhabs and so on and so forth, and other minds. What you're seeing out here are the leaders in Islamic financial transaction laws of our time. These are, if you're in the medical field, there are generalists, general practitioners, there are cardiologists that are specialists in the heart, and then there are the best cardiologists in the world. I always say, when it comes to Islamic financial transaction laws and the fiqh of Islamic finance, these are your leaders in Islamic finance. Alhamdulillah, we were very fortunate to actually bring them all together in 1999 for the creation of this program. And they still serve, with the exception of one who passed away, Allah yarhamu, Dr. Abdul Sattar Baghudda from Syria. But the rest are still part of our Sharia Supervisory Board, and they still audit us once a year to ensure on every product, not only the Islamic Home Financing Program, but anything we do globally. They delivered for us, upon launch, fatwa about our program. And there are a number of fatwa. The main fatwa is the one about the permissibility of the program. But they thought 2 steps, 3 steps ahead. And they even created fatwas on very specific areas of the agreement, because they knew that American Muslims ultimately are going to ask questions and wonder about certain aspects. The contract itself, and some of you who've closed on a home, you've sat at the closing table, at the settlement table, and I'm sure you stared at that stack of documents, right? It's a large stack, and you had to sign, sign, sign. The majority of those documents are disclosures. They're government mandated disclosures. They're not the contract. They don't even bind you to anything. They're just FYIs by the government to ensure you know what you're doing. That's all they are. There's one document, that's the contract. Right? In the conventional mortgage world, it's the lender agreement. For us, it's the co-ownership commitment agreement. We're going to get into that detail very soon. But they even went to the extent that they looked at those disclosures, because we looked at those disclosures and said, there's a problem. All of these disclosures are mandated by the federal authorities and the regulators, and they have words in them that say borrower, lender, interest, loan. So we took issue with this, because it doesn't characterize our structure. It doesn't characterize our relationship based on the contractual agreement we have with our customers. We did try to go out and say, could these be customized to represent a different segment of the market that we serve? And the segment cannot be lenders, and they are not, borrowers, and they are not borrowers based on our agreement. Of course, I think when you don't have that kind of mass quantity demand, you're not going to get any special treatments. So our Sharia Supervisory Board even went to the extent of drafting a fatwa addressing disclosures, and why you're going to see these disclosures in they do not represent the contract. They do not characterize or recharacterize the arrangements. That was an important aspect. And there's many other fatwa, but I thought I'd share that with you to help you understand the level of effort. And believe me, when you're talking 3 years of R&D and development work, layers and layers and layers of complexity. To shift now about the topic that I think we all, on a general level, understand, riba. So we all understand the prohibition on riba. We all understand what the Quran states about riba. It's pretty black and white. The Quran, Allah subhanahu wa ta'ala talks about riba in a way in which He warns us. If you are going to pay or receive riba, expect a declaration of war from Him and our Messenger, sallallahu alaihi wasallam. I would call it a very dramatic statement in the Quran, but a warning, because it wasn't just banned for Muslims; it was pre-Islam banned for all humanity. It was banned for Christians, it was banned for Jews, and there's proof of it because it's in the Old Testament. This other section of the Quran gives us a little perspective on why, as human beings, we keep making the mistake of engaging in riba. And it says, those who take unlawful interest will stand before Allah on the day of judgment as those whose minds have been corrupted by the influence of Satan, of shaitan. They say that commerce is just like interest, but Allah has made commerce lawful and has forbidden interest. That statement, they say that commerce is just like interest. All the people of the book said this. They didn't understand the difference, and they justified riba because they felt like it was just like commerce. Allah comes back and says, commerce is lawful, riba is not. Distinguish between the two. And we're going to do that tonight, inshallah. This is what our cousins were told in the Old Testament. And I'll point to these two. They're very, very direct. In Leviticus, do not take interest of any kind from him, but fear your God so that your countrymen may continue to live among you. And in this one, in Exodus 22:25, this is a very powerful verse. If you lend money to one of my people among you who is needy, do not be like a money lender. Charge him no interest. Remember, lending money. Lending money. So riba, what is it? It's profit collected or paid on money borrowed or lent. Plain and simple. And why is riba haram? First, it's the creation of something from nothing. And only Allah subhanahu wa ta'ala has the power to create something from nothing. No matter how wealthy we become on this planet, no matter how wealthy we are in this dunya, we cannot play God. We cannot all of a sudden use our money to create something from nothing. And I'll give you an example. If I was to hold up a $100 bill right now, $100, and I said, I'll sell it to the first person who raises their hand for $150. Any takers? No? It's pretty silly. I don't think anybody here would buy a $100 bill for $150. What did I just do? I created $50 out of nothing, out of thin air, just because I had $100. But day after day, the banks are doing just this. On a simple contract that says the loan. And in this case, they step back and don't take any risk with the individual they're selling this money to. They don't take any risk. So riba is prohibited because what happens next is an abomination on humanity. So if I came under the guise of wanting to loan people money, wanting to help the needy, and I lent them money, and I said, here, take $3,000. I'll only charge you $1,000 on top. And they cannot pay. What happens next? I probably would charge what? A late fee, correct? All kinds of late fees. It happens today on mortgages, 5% on your monthly mortgage payment. But what happened back during the days of the prophets when people couldn't repay their loans? The lender would go and confiscate anything they owned, everything they owned. But when the lender could not get back what is owed plus interest, and the borrower didn't have it, didn't own anything else, what happened next? Well, the next step ultimately led to slavery. You became an indentured servant. Now, one human being owned another human being. And this is how that cycle continued from one generation to the next, to the next, to the next. It literally led to slavery. And so, just because one person had and somebody did not have. And so, the loan agreement, if you remember anything tonight, I would remember this. The loan agreement, which is an agreement, it's a contract. It's meant for one purpose and one purpose alone: charity. That's where it belongs. It belongs in charitable activities and charitable transactions. It does not have any legs to stand on when it comes to investments. So, what does Islam tell us is permissible? Because it's not like Islam closes one door and leaves it shut. We have many doors, we have many options. And Islam does provide us solutions. The, you know, the path may not go through the loan, but there is a proper path to helping Muslims trade with one another, create investments, and engage in contracts that are Sharia compliant, contracts that are not based on lending and borrowing. So, what is permissible? Islamically, charging a fee on a usage of an asset is permissible. We want to use this facility. The masjid is in its own right, can charge us a fee to use it. Any one of you who is leasing a vehicle? Anybody leases a car in this room? I know I lease cars. I've always leased vehicles. That's charging a use of an asset. That's halal. Buying and selling an asset or a portion of an asset is halal. Absolutely. Profiting from ownership in a permissible revenue generating arrangement. Profiting from taking ownership in a revenue generating arrangement that is halal is halal. Permissible, yeah. So permissible revenue generating arrangement. So I can't take ownership of something that's generating revenue and take, portions of it, like a stock of a company that's generating revenue from things that are haram. I have to be mindful where I put my money. Now, there are titles to these arrangements. These three titles, there's more, by the way, than just these three, but for the sake of time, are titles to contracts that are in Islam permissible. One is murabaha, second is musharaka, the third is ijara. Ijara is very simple. Remember that car lease I just discussed? That's an ijara. You sign an ijara. You're using an asset, and you're not owning it, but you're just using it and you're paying for usage. Murabaha is a purchase and resale. If I bought, let's go back to cars. I don't know why we're using cars as an example, but if I bought a car for $10,000 and I actually worked on it, made it better, maybe spent $1,000 to upgrade certain things, I can turn back around in the marketplace and sell it for $15,000, and I can even sell it on installment. Okay? That's permissible. That's a murabaha transaction. Now, the middle one, we highlighted in gold because that's the one we're going to dig deep in, musharaka. Now, many of you, if you speak Arabic, you know the word musharaka, and you probably know, oh, you don't have to teach me about musharaka. I understand it. It's partnership. It's like my uncle and my father bought that gas station years ago, and they engaged in that business. One brought 70%, another brought 30%. They bought it. Now the expenses are split 30-70, and the proceeds from any revenue that's generated, 70-30. Well, that's one type of musharaka. That type of musharaka has a name, actually. It's called shirakat al-aqd. Shirakat al-aqd, joint enterprise. Look up at the top, you see shirka just means sharing in something. Shirakat al-aqd is all about joint venture, joint enterprise. Many of us know that type of musharaka. And it even works with partnership in services, consulting services. You can even partner with people to provide consulting services. And ultimately, if you sell the company, you get back your share in whatever it is 70%, 30%. That is not the contract that our Sharia Supervisory Board advised us to use for facilitating homeownership in the United States. Not Shirakat al-Aqd. They advised us to use something called Shirakat al-Milk. And many of you probably will know Shirakat al-Milk once I explain it in the compulsory fashion. Shirakat al-Milk means joint ownership of an asset, becoming a joint owner in an asset. What is in a compulsory fashion? I'll use the example of someone passing away. Someone passes away. Their property is now all of a sudden passed down to his or her children. Now, if his or her children wake up one morning and realize that's what occurred, in that instance, they are now partners. They are now partners in the ownership of the asset of the deceased. They have a decision to make now. The decision is, do we live in it together if they happen to have families and lived outside the household for some time? Or do we liquidate it? And there are times when, of course, one says, I have a house, I just want to liquidate it. And the other says, I'd like to live in it. And now an arrangement has to be done to do what? To transfer ownership from one party to the next over time, perhaps. And there's usage involved and so on and so forth. That's Shirakat al-Milk. And I'm sharing this with you because the optional version is what we've chosen to execute on for our contract. It's optional for two parties to come in and co-own a home and transfer ownership from one to the other. This is a quick video that'll give you a less than 2-minute example of what I'm referring to. And what you hear in the video towards the second half of the video is why this is beneficial to humans, to Muslims. What are the benefits of structuring a mortgage this way? So bear with me.
You're a potential homeowner, and you need to understand how home financing works and what types of risks are involved in the process. For that, we need to take a closer look. The current financial system works like a factory that sells money for more money. When you go to purchase a home, a traditional bank will happily lend you the cash you need, add interest, and they'll even pass along all the inherent risks of home ownership to you as a bonus. So in the event you fall victim to a natural disaster, eminent domain, or a foreclosure, the burden to repay the full loan amount falls directly on you, with no one to help shoulder the load. Beyond its obvious shortcomings, lending and borrowing at interest is also in direct opposition to what all monotheistic faiths preach. There is, however, an alternative. Guidance Residential's declining balance co-ownership program is rooted in the traditional Islamic belief that money has no intrinsic value and thus can't be sold at a profit. The program is a non-lending method to facilitating home ownership. Through Guidance's co-ownership agreement, you purchase the home of your choice by entering into a diminishing partnership where your obligation is simple. You agree to buy out Guidance's shares while also paying a fee for using the portion of the property you do not yet own. As your ownership increases over time, the portion of your monthly payment dedicated to this rental condition decreases. What makes this better? You can fully buy out Guidance's shares at any time without a prepayment penalty. If you're late making a payment, you don't need to worry about the typical 5% late fee that traditional banks charge and profit off of. Our reminder fee of $50 or less covers our administrative costs and never compounds. In the event of default, Guidance will only reclaim its share from the sale of the property, whereas other institutions typically pursue you for any proceeds not covered by the sale of the home. Should the property be lost due to a situation involving something outside the two parties, like eminent domain or a natural disaster, Guidance will share equity loss equal to the percentage of our ownership. With Guidance Residential, you don't have to worry about the worst case scenario. We're here to share the risks and benefits of owning a home with you. It's something we like to call modern finance with timeless values. Visit guidanceresidential.com.
Okay. Well, this is a diagram to quickly show you what just happened. And yes. Could we leave it to the end? Because I'm going to answer as all the questions you guys have, just so I can get through these slides very quickly. And believe me, I'll start with you. So this is a 4-step process, and I'm going to show you in very simple terms, what makes it different from a four-step process of a conventional mortgage. And I'm going to walk over to point it out for you. That. See that little piece of paper? That's the contract that's signed under a Sharia compliant, under the decline balance co-ownership program. It's called the co-ownership commitment agreement. It literally creates the right characterization of the parties and their roles and responsibilities to one another. It makes us co-owners in the property. It makes the buyer our co-owner in the property. And now it establishes us soundly in this asset. The next part of the contract is the obligation on the parties for the next however many years we've agreed on. It's called the term. So it could be 30 years we agree on that this program should expire, or 20 or 15. It's up to the buyer to decide the term. But once we move into this, let's say it's 90-10, we can go to the point where we can provide up to 97% of the value of the home, you bringing 3%. That's as far as we can go. But let's assume it's a 90, or in this case, it's using 30-70, so we'll use that. So each party's ownership now is determined by the down payment. From there, steps 3 and 4 are pretty simple. Pay a monthly statement. Monthly statement is locked for 30 years. But there are two components that shift. One is the utilization fee, and one is the acquisition amount. The acquisition amount is simple. Each month, part of your portion of your payment is buying us out. Because as much as we love our customers, we don't want to live with them for life. We want them to become sole owners of the property, right? And so one portion of the payment is acquisition. The other portion of the payment is called the utilization fee. You saw the video, and it's pretty simple. If you're owning 70% of the property, we're not going to tell you, hey, sorry, if you're owning 30 and we own 70, we're not going to tell you, stick to your side of the house, the 30%, and we're going to hang out in the 70. We're going to give you exclusive use and enjoyment of the entire property. It's in the contract, including the portion you don't yet own, but you get exclusive use and enjoyment of it as long as you pay us a utilization for that portion of the property. Now, what happens on month number 2? Your utilization fee decreases. Month number 3, you're paying less utilization, and so on and so forth. And at any point, you can make a large sum acquisition and buy us out. At any time, ahead of the term. There's no penalty for that until you become 100% owner. Now, what happens on the flip side? Conventional mortgages, banks and others. That little piece of paper, and look it up. They all use the same document. It's called the lender agreement. That's the title of it. It's as old as the mortgage industry in the US. And it says you are officially a borrower of money at interest. They are the lender of that money, and they want their money come hell or high water. And you are literally paying back the loan on interest until you fully paid it off. Now, what's the difference? Well, if we loan you money, we have power and leverage over you that you will not be able to withstand should trouble arise. Should trouble arise. What kind of trouble? Well, first of all, you weren't able to make a monthly payment. Okay? You had some financial difficulty, you missed one payment. In the industry, they'll charge you 5%. Payment of the monthly payment, it's 5%. It's pretty standard, and there's no questions about it. So if you have a $3,500 monthly payment for your mortgage, anybody can do the math here? What's 5%? 175. There's some really sharp individuals in the room. 175. $175. That's your late fee. What happens at the second month if you're late again? It's the monthly payments plus the original 175 times 5%. It's called compounding late payments. The banks and the financial institutions are very clear on this. In fact, when they project their uh, um, annual business projections and volume, they actually create a column for profit for these types of things. It goes straight to the bottom line. Now, when we rolled out, we were asked by our Sharia Supervisory Board to conduct a study. The study had to tell them what it costs us to actually remind somebody who ends up being late. By law, we have to send you a letter in the mail. Even though we sent you your mortgage statement, we got to send you another letter that says you missed your payment. And by law, we need to call you and actually say, did you forget? You missed your payment. Those are administrative costs. So we needed to literally run a study. We ran a study. We hired a group, and the study presented us with $50. For a small mortgage company, it's $50 in administrative costs and materials. That was our late fee, capped at $50, because it shouldn't inconvenience us when somebody's late, and that's all. We cannot make a penny on that late fee, and we've grown since those years, and it's still at $50 capped. Non-recourse commitment, it's pretty simple. If a $100,000 property is what we contracted on, we brought 90,000, you brought 10,000, and you couldn't make your payment for 8, 10, 12 months, and we went through the forbearance plans and the forgiveness plans, and let's just fast forward to this isn't working out. We have to, at that point, we have to go into foreclosure proceedings so we can liquidate the property and go our separate ways. What happens if we sell the property, because the market's down, $70,000? Conventional banks, it's called recourse. $70,000, but you owe them 90. They want their 20,000. And you know what else they want? Because it was 6 months of late fees and compounding late fees and such, and penalties. They want that too. In 2009, I would urge you to look this up, the fun, depressing fact, but in 2009, after the entire mortgage industry collapsed and the economy then went with it, you had banks go to judges, go to state and federal judges, asking for them to issue deficiency judgments on people who walked into the bank in '08 and gave the bank their keys and said, I cannot make these payments, I lost my job, take it, I'm underwater. The banks took it, liquidated it, there were shortfalls, and they chased these buyers for 3 to 5 years with deficiency judgments. The state of Florida, by the way, issued more deficiency judgments in 2010 than in the history of the state since the Great Depression. And they went after these buyers, even if they left the state. And they knocked and said, you still owe us $50,000 plus 20 in late fees. Pay up. If not, the sheriff here is going to actually take your new car, your savings account, and so on and so forth. The only thing they can't do, because it's illegal, is slavery. But that's recourse, ladies and gentlemen. It's recourse. We have what's called a non-recourse clause in every contract in every state, even if the state allows it, and many states allow it. Now, why do we have a non-recourse? We didn't loan money out. There was never the exchange of money. There was never loaning of money. Our money is tied up into the asset. So if the asset gets liquidated, that's it. Our agreement is dissolved. It's over. We take that loss. That $20,000 sells for 70. That 20 is a loss on our books. For you, it's a $10,000 loss, correct? Third, and I'll tell you, this one gets even more consumer friendly, because nothing like this exists in the United States. There are two scenarios where you did nothing wrong as a consumer. You didn't default. Nobody defaulted. Everything was working just fine, but we had to dissolve the agreement because of two scenarios, two forced upon us. One is natural disasters. Another one is eminent domain. If the government comes knocking, you can't resist. You know, in highly dense communities and cities, the highways have to be expanded, schools have to be expanded, so the government will exercise eminent domain to take land, but they'll pay you for it. There's proceeds. In a natural disaster, the proceeds come from where if the house is completely demolished? Insurance, correct. So what happens if the proceeds from insurance and or the government, let's say on that $100,000 example, that the proceeds are 70. The insurance adjuster felt like it's a $70,000 house. Typically with a conventional mortgage, you're on the hook. You still owe 90. With us, that 70, we would take it and split it according to the percentage of ownership at that time. So everybody gets their equal share in that loss. And on the flip side, if the proceeds are much higher, 130, 140, the consumer takes all the appreciating value above 100 plus their 10. Why? Because the consumer selected the house. They went out and searched and found the neighborhood and found the house. See, guidance's role in this is not to profit off of anything except usage, utilization of our portion of the property, and that's it. I'm not even going to bother with this. This was insane in 2002. Banks actually charge you a prepayment penalty if you paid off your loan within the first 6 months. So go figure. But we never had that, of course. Um, there are two main myths. I'm going to dispel them for you here, and then we're going to open it up to question and answer. One is very simple. Everybody thinks, oh my God, did you say Freddie Mac? Did you say Hussam? Fannie Mae? Astaghfirullah. So you borrow money from these guys. Astaghfirullah. No, I think it is an important aspect of what we do is educate. So Freddie Mac and Fannie Mae both are what's called government-sponsored enterprises, GSEs. They were actually chartered by the US Congress many, 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 many years ago for the sole purpose of creating liquidity in the housing industry. The US saw that the housing demand is going to grow. And banks do not have in their depository accounts enough money to help provide financing to the demand that's going to be out there. We're talking trillions of dollars. And why was it important to create liquidity to allow that to have money available for folks to be able to access it? Now, we're not arguing they access it through borrowing it, but the US government looked at this and said money needs to be there because the housing industry represents almost 80% of our economy. If you think about housing, it is the engine of the economy. When somebody buys a house, where do they have to go? Typically Home Depot, Lowe's, the hardware store. They're going to have to hire what? A plumber, an electrician, a roofer, a landscaper. This generates so much for the economy. It creates jobs and it circulates money. It's a good thing for the economy. So this is their purpose was to create liquidity. Now, Freddie Mac and Fannie Mae's job isn't just to buy these mortgages. They're to take these mortgages, pool them in what's called a mortgage-backed security. A U.S. mortgage-backed security is a safe bet for foreign investors. Who are these foreign investors? I'll give you one example. Let's take Germany, for example. The German or the French Teachers Union. They have a pension for those teachers. The pension fund manager for the Teachers Union of France needs to invest that money that they're collecting from these teachers so that when they retire, they have a pension. Typically, about a third, if not a quarter, of that fund is invested in U.S. mortgage-backed securities issued through Freddie Mac and Fannie Mae. So think of it as a stock that's actually generating liquidity from international financial markets into the U.S. So I want you to keep that thought in mind because first and foremost, the myth, I'm going to dispel it. Freddie Mac is not a bank. They're not a bank. And the second one, Freddie Mac is not a lender. They're actually prohibited from lending money. They are not allowed to be a lender. They are an investor. Now, the way to think of them is this. They're a silent investor. So our arrangement with Freddie Mac and Fannie Mae, when we launched it, we were very fortunate, in fact, because when we went to them, they were not very receptive at first. And then we were fortunate because someone in their legal counsel division said, listen, I'm from the Middle East, and I represent the argument that you should go and try to figure out what these guys are doing at Guidance to help Muslims buy homes. And that opened the door for us for a conversation. And that conversation led to Freddie Mac saying for the first time, we will move into investing in, as a silent investor, musharaka mutanaqisa structured mortgages. That was a huge turn of events. So what they act as is a silent investor. They take our position in the musharaka structure, but they do not alter the contract whatsoever. They're forbidden to. The contract's locked for 30 years. What they're interested in is one thing: the utilization fee that's being generated over the course of the next decade, 2 or 3 decades. And they cannot change the contract. In fact, we retain the servicing of that contract, and our relationship is always going to be with the customer and the customer with us. They're just pretty much in the background. Now, they have one demand, and it's pretty simple and it's pretty fair. The demand is we have guidelines, investment guidelines. We're not going to invest in this if the customer's credit score is below 620. Fair. We're not going to invest in this if the customer, has defaults, has debt that's higher than their income. Fair. So I want to make that clear, and I'm sure there's going to be questions about this, but let's go to the second myth about this organization called US Bank. How many of you have heard of US Bank? Is it out in California? Okay. It's a pretty reputable and long established bank. We don't deal with US Bank, we deal with something US Bank Servicing Division. How do we deal with US Bank Servicing Division? A lot of folks probably don't even know what a servicing division is. Servicing in the mortgage world means you're a vendor that helps to do servicing work, such as sending out monthly statements, collecting the monthly statements, and being a resource for people who need to make additional payments, being a resource for people who want to check on their payments if they ever got to us. Typically, mortgage companies our size don't in-house this work. Because if we were to in-house this work, we would hire a group of 30 customer service agents, and their job is literally to lick envelopes, lick stamps, stuff them, and mail them, and take calls and say, we didn't receive your payment, please send it, or thank you, we received it, here's what your account looks like. It's an administrative task. If you in-house this task, it can cost you quite a bit. And so typically, companies like us outsource. They outsource it to servicing agents. US Bank found that the servicing of these mortgages is a good business to get into. They got into it. We actually moved with them years ago after interviewing them and helping them understand that if we're gonna hire you as a vendor to do this work for us, you got to make sure your team is trained about what they're doing with our customers. They're just collecting payments, and they cannot call our customers borrowers. They cannot call us lenders. They must understand our rules. And so it became a pretty good arrangement because it literally saves us money to have it outsourced. So what are the misconceptions? Let's clear them up. US Bank is not affiliated with us whatsoever. And they are not a party to the Musharaka program that we offer whatsoever. They are simply they're assisting us in an administrative task, let's call it. They're a vendor. That's really all they are. And so folks sometimes, they say, I heard about US Bank. What are you doing? If tomorrow another organization had a great servicing track record and we wanted to use them because they have favorable rates, we would probably use them as well. So, okay, yeah. So we are not a bank, and why do we have something like this on the presentation? A lot of folks think we are a subsidiary of a bank. A lot of folks tell us, "Oh, you're like every other bank. You must be owned by a bank." It is important for us that we clarify these misconceptions. Why? Because we worked very, very hard very, very hard to establish ourselves as a standalone Islamic financing institution. We are a financial services company. That's our DNA. That's what we are. And this short video. Let me see how. Are we good on time? Do we have time for a 2-3 minute video? Will there? Okay, I'll play this video and then we'll go to Q&A. It is honestly just it will help bring it all together and then we can go to Q&A.
For many, the American dream can be summed up in two words: home ownership. However, Muslim Americans who live by the ideals of Islam will never achieve it through conventional financing. That's because, like other Abrahamic faiths, Islamic law strictly prohibits the practice of riba, which is the lending and borrowing of money at interest, something conventional banks don't have a problem with. You see, a bank converts cash deposits into debt, and the more debt they sell through credit cards or interest bearing loans, the better. Moreover, they are value neutral, meaning they lend to a variety of borrowers, some of which contradict their customers' values and principles. So, financing a home through a bank means actively enriching a bank and its desire for more riba, while indirectly supporting ventures prohibited by Islam. Not your ideal partnership, not your ideal partner. So, how do you buy a home without compromising your ideals? What you need is a little guidance. Since 2002, Guidance Residential has helped over 30,000 Muslims realize the dream of homeownership without compromising their ideals. In fact, Guidance is the only home financing organization that actually establishes a co-ownership with consumers via a limited liability company, or LLC, offering a Sharia-compliant way to purchase a home. That's why the Assembly of Muslim Jurists of America, or AMJA, has called Guidance and its co-ownership model the most permissible path to Islamic home financing. In this diminishing co-ownership, the consumer agrees to buy out Guidance's share and pay a usage fee for the portion of the property they don't yet own, which lessens as their stake in the property grows. Now, some banks, through subsidiaries they have created, claim to have adopted similar models to Guidance's co-ownership program without setting up an LLC that would legally establish co-ownership. They also claim that these subsidiaries they created are not part of the bank and are merely a passive investment by the bank. Here are the facts. According to U.S. Code Title 12, Chapter 2, which governs the conduct of U.S. banks in the business of banking, banks are precluded from investing in and owning real property, meaning they can't become owners or co-owners of real estate. This is one of the main reasons they can't set up an LLC, which would establish true co-ownership in real property. As for the bank's claims of simply being passive investors in a subsidiary, U.S. Code 12 CFR Section 5.34 E2 states that a bank must have complete control of the subsidiary's management team and operations of the subsidiary, and no other person or entity has the ability to exercise effective control or influence over the management or operations of the subsidiary. In other words, the bank subsidiary is an extension of the bank and is governed by U.S. banking laws. As the only non-bank and riba-free financing provider approved by an independent, world-renowned Sharia board, Guidance understands and shares in the ideals you live by. The American dream of home ownership, made possible with a little help from Guidance Residential, your exclusive partner for Islamic home financing.
Oh, okay. Thank you for watching that. I know it got a little technical, but our business is technical. Our business is very complex, and the laws around banking and such, consumers don't know what those laws represent. And for us, it is important for folks to understand that to do things right, it's more complicated, it's a lot more detailed, and at the end of the day, if a financing outfit is a subsidiary of a bank, you can pretty much rest assured that the likelihood of riba transferring back and forth, being in that agreement, is pretty high. And it's unfortunate, but there are definitely institutions out there who enjoy taking shortcuts and just looking at the Muslim American community as a community where they can supplement their profits, supplement their riba-based profits, And anything that can do that can help them grow their empire, which is lending and borrowing at interest. So I'm going to stop right here and turn. We're going to turn on the Q&A, and I'm going to start with the gentleman in the back who raised his hand earlier. Thank you for being so patient. Yeah. Ah, great question. The utilization fee in that scenario does not change. It doesn't change because any appreciating value in the property goes back to you, the homeowner. It's yours. Remember what I said at the beginning? This was a shirakat al-milk, not a shirakat al-aqd. Shirakat al-aqd would say, hey, we're going to venture in real estate together. And when property values go up, we both win. Our profit, we're pretty transparent. We make money from utilization, like you said, and it's locked at the original value of the home and at the original. So our percentage, you said 50% ownership, that's declining every single month, and you're actually paying me less utilization every single month. Property value could go up to $1 million. Doesn't change it. It stays there. Yeah. They're gonna take, yeah. Yeah, no. In our case, yeah, and you're absolutely right. By the way, I think we could do a lot more to help educate and close these gaps. But yeah, in our case, it's $100,000. We established the co-ownership on that day that it was valued the home at $100,000. So from there, we start to transfer ownership at that value, and our utilization fee is our utilization fee at that value, at that percentage, right? The 50%, and it can only decline from there. Yeah. Original. Original. Not the sale. Yeah. See, the wisdom in this is we wanted to help Muslims become homeowners. We wanted to facilitate homeownership for American Muslims so they can benefit from the value of entering the real estate market. We didn't want to take away value from them from entering the real estate market, but we needed to facilitate it in a structured manner that abides by Islamic financial laws. And that's pretty much it. And we make it clear our profit motive in this is utility, the usage of our ownership stake in the property, and only that. And that constantly decreases with every single payment. So any appreciation is yours. It's yours. We don't even deserve it. We didn't find the property. You know, you worked hard to say, I like this zip code instead of that zip code. I like that house instead of that house. And you might have worked with a good real estate agent that you did all of that, not us. Okay. I'm going to answer that and then I'll take your question next. Ho- and then you'll come third. So, how do we establish the utilization fee? That's a great question. During those 3 years, when we were in these boardrooms with the scholars and the lawyers and the law firms, towards the tail end, this question came up. Somebody asked the scholars, "What do you think we should? What should we charge for utilization fee?" And they laughed. They laughed. They said, "That's not a Sharia question. What you charge is up to you. We don't tell you what you should charge. I mean, if you want to ask us our personal opinion, you better be competitive. Be competitive, right? But they said it's up to you. And so the you know the our brains started to work. Our brains started to kind of think about different theoretical examples of what a usage fee should be like. One example, and I'll share it with you guys. We didn't use it, but one example was, well, we should look at the prevailing rental rates of the homes in the neighborhood where this home is and do an estimate and say, okay, the rates of homes in this neighborhood where we're going to partner with you on, to $2,500 a month. And so 50-50, we'll charge you half of that, right? There was a flaw in that. The flaw was not every home is going to be $2,500 in rental value in that block. In fact, a house across the street could be 3,000 or 2,000 because they either have a better kitchen, a better more upgrades, and so on and so forth. So now imagine trying to doing that in every zip code, every street corner in 35 states across the country. Madness, it wouldn't work. And then on top of it, that theory really hit a brick wall when someone said, well, what if the rental rates are much higher than the prevailing rates on a mortgage? Then you're really charging Muslims a lot more. So that idea did not go anywhere. So then when we were talking to the scholars on our board, one of them mentioned, listen, don't make it more complicated than it is. You have a ruling that says benchmarking is halal. And then, of course, that term, benchmarking, what does that mean? So they said benchmarking. So you want to look at who is in this industry that's facilitating homeownership. They're charging something for facilitating homeownership. Just benchmark against whatever that cost is because the consumers are used to that cost. So in this case, benchmarking against what the banks charge for allowing you to borrow money is a cost, a dollar, right? It ultimately translates to a dollar. So we benchmark against them to stay competitive for our usage fee. So our usage fee is essentially benchmarked every day, 2 or 3 times a day, against whatever is happening in the conventional riba-based mortgage industry that facilitates homeownership so that we stay competitive. This is okay. Now, our chairman, Dr. Muhammad Hamour, he and I were speaking one night, and he said, Hussam, look, some Muslims are not going to get this, but it has to be, they have to understand. And he used an example that I thought was brilliant, and it made me laugh, and I'll share it with you very quickly, and then we'll go to the second question. He said, look, if we walked into a 7-Eleven, do you guys have 7-Eleven down here? He said, if we walk into 7-Eleven and we see there's potato chips being sold on the shelf here, and each bag is 99 cents, is it halal or haram to eat potato chips? I said, well, potatoes are halal. So I don't, I mean, if that's a trick question, he said, you're right, potatoes are halal, but if you pick up the bag, 99 cents a bag, if you pick it up and you read the ingredients, and it says, these potatoes are fried in lard. Now can we eat them? We have to put them back. So tomorrow, I want to help Muslims eat more potato chips. I want to go into this market. I go and I get my Idaho potatoes and I cut them really thin, but then I fry them in vegetable oil or coconut oil. And then I package them nicely and I go to market. And now the question becomes, well, what am I going to charge for these potato chips? If I charge 99 cents, I'm haram? Answer is no, of course not. You're not haram for charging 99 cents. It's the process. It's the relationship the contract actually creates. Contracts in Islam are critical. So you want to create the right relationship between the two parties to avoid the creation of riba. And riba is merely the result of something that's being created over nothing, over a loan. But you can eliminate riba by literally becoming having vested interest in the asset and having the consumer pay for something that's tangible. Usage. Usage of what? Usage of this property, the portion they don't yet own, to be fair. Now charge what you want. Peg, benchmark, that's halal. So that's how we literally have a pricing division, in a pricing department in our office, in our corporate headquarters, that check the prevailing rates on money being loaned out today 3 times a day. They check Chase, they check Bank of America, they check Wells Fargo every day, 3 times a day. But us, we're just looking for the cost. What does it cost to facilitate homeownership in the market today? Because it could be different tomorrow and the day after. But once we identify where we want to be from our costs, when a customer engages in our musharaka structured mortgage, we lock it. We lock it at that amount, and that's the cost of utilization. So that's how we got it. You got it. So the difference here, you're absolutely correct. There is no cost advantage or disadvantage of going in a Sharia compliant structured mortgage. There's just competitiveness, but you're not trying to go, Islamic finance or faith-based finance is not meant to be free finance, or it's not meant to be cheaper finance. But that's how we structure, yeah. Now I promise I'll go to you next. Sure, sure. Yeah. What's the process? Well, we can turn around a pre-approval, which is a legitimate underwriting pre-approval letter for the amount that you can finance from us in less than 24 hours. We'll need some documentation, of course, from you. We'll need to make sure we understand what your credit score is like. We need to make sure that your income levels are not out of whack from your debt levels if you have debt, and so on. So we run the test against the financing guidelines that are issued today by our silent investors. We want to make sure we don't go beyond what their threshold is. So we will literally do that for you um, within 24 hours. And once that happens, you can take that letter, which is pretty much as good as cash, and you can go shopping for a house. And when you submit an offer on that house, you put that letter right on top and submit it with your offer. The moment that offer gets accepted, you will come back to us. And from there, we will look at the closing date on the ratified contract, and the real process begins. So you'll get a conditional approval from there. We'll order the appraisal. Your agent will order the inspection report. We'll go to the point where if there's any conditions that the underwriter sees and needs, will be communicated to you. We literally have our own internal engine and an app that helps you identify everything you need through this journey. We're pretty sophisticated from that front. I mean, we have an internal IT department and an entire it's like an army of coders and software folks who developed things exclusively for us because we cannot use anything off the shelf. Everything off the shelf states terms that don't characterize us properly. So you will be updated through a document portal, what documents are still missing until we get to the closing date. And that goes to, we select a settlement agent and go to that closing date. And that stack of documents that you're going to be ready to sign, the heart of it will probably raise eyebrows. It is. It is very much the same. It's very much the same. And not to toot our own horn, but we've been able to turn around on purchase contracts, closings in less than 15 days. So we're pretty much ramped up. We have an infrastructure that can help us move very quickly through that process. We've been doing it for 20 years now. You had a question.
In other words, you are saying that credit, what is the score?
Our profit rate? Or you don't?
Score is also important. We are like your the traditional lenders, isn't it?
Could you repeat that question? Credit score. Yes. Yes.
Credit score is also important to you.
Yes, it is.
Like the other traditional
Yeah.
lenders.
Absolutely. Look, credit scores are important to us. Absolutely. Your income and the stability of your income, all important things. Because we're literally going to take on more risk than your traditional mortgage company. Yes.
Now another question is that do you need insurance for the home insurance? Who pays the premium?
Yeah, great question. So the question, if you guys didn't hear it, do you also require insurance on the home? And the answer is yes. It is home insurance is absolutely required, and the premiums are paid by the consumer on the contracts. There are actually two programs that we offer every customer. We offer, and typically a customer will default to one. The programs are the same, with the exception of this property insurance. The the first program essentially says, look, we we're not we will we do not need we are not responsible for certain parts of the home insurance program, and I'll explain why. When you buy a home insurance today, property insurance, it's actually a bundled insurance product. And bundled means it covers you on liability, it covers you on personal possessions. For example, personal possessions are your mattress, your curtains, and so on and so forth. So that part, it's not, we don't have any personal possessions in the house. So that's actually protecting your personal possessions. Another one, the liability, is something that you actually are responsible for maintaining, right? So if it snows, I know it doesn't snow out here, but if it snowed in the East Coast and such, somebody slips and falls in front of your house, guess what?
I'm not 100% owner of it.
Well, but
I have paid you. I'm paying you for your major person until you are major. I am
right,
paying you.
right. So a misconception, I need to address it, because when somebody believes that they're co-owning with us and they own, let's say, 30% of the property and we own 70, that, oh my God, we need to share in everything, 30-70. That's a misconception. Remember going back to Shirakat al-Aqd? Shirakat al-Aqd versus Shirakat al-Milk? Shirakat al-Aqd essentially says everything 70-30. Expenses, just like a restaurant, for example, it's 70-30. Shirakat al-Milk does not say that. Shirakat al-Milk says someone is occupying the property fully and benefiting from all of the things that come with it.
Insurance, you are not paying the extra.
No, no, no. So I was going to answer your question, but
That I know. That
yeah,
what I just want to know why yes or no. That's all.
right. So you have two options. We can actually share in the insurance, but it will be more costly because you'd have to ask the insurance company not to bundle the pieces of the insurance, or bundle it and you take the cost because it's actually going to be reduced. That's the answer. Yeah. And it really is what it is, because we went to insurance companies and says, can you, I don't know if debundle is a word, but can you separate the insurance items? And they said, yeah, sure, no problem. And then all of a sudden, the price skyrocketed. Okay.
So it is theoretical question. Just for knowledge. But you said that if you appreciate, the appreciation of the property,
Yep.
right? Appreciation is all to the owner. I mean the buyer.
Correct.
But if it is depreciate, then what will happen?
Yeah, that's a good question. So, yeah, I'm going to repeat that. The gentleman's asking, okay, we know that if during the property appreciating value, that the customer receives all the value. But what happens if it property depreciates? So when we engage in this contract, we say to our customers, look, we hope you're not flipping the property. You have the right to do it, but you're going to take on the risk if you do it. So that means if you buy the property and you decide, let's say $100,000, and you're not looking at it as a long-term investment, and the property value goes from 100 to, let's say, 70. Um, you decide you want to sell. Now you're making the decision to end the arrangement early. You're going to have to understand that that is on you, not on us. So, so the reason we say that, so I don't know if you heard the answer or not, but um, we we talked about if you make the decision to exit early, we as your partner would recommend not to exit so early that you don't even have any equity, you didn't gain any equity, that you end up losing equity, because that would be on you. So the idea for this is for you to stay in the property minimum 3 years more, and so that you can gain equity, gain enough that it actually doesn't hurt both of us, because you're going to make a unilateral decision. The decision we go into this with is we're with you for 30 years. And we know in 30 years, we know in 15 years, the property is going to appreciate. We're not going to have that problem. In some markets, we're going to know in 5 years it's going to be just fine. But if you make the unilateral decision to exit early in a year in a down market, that is your responsibility at that point. Yes, and then I'll come to you second. We do. We do. You would invite us in to say, look, would you mind refinancing our property? It's paid off. I want you to buy shares. So we would literally appraise the property right at that point, understanding its value the day we will interact. And then we'd ask you, how much do you want to cash out? And we would have a position in the house equivalent to that. And then you free up your equity, which a lot of folks do. You had a question.
Thank you, sir. I have
You're
to
welcome.
leave because I just got a call.
You're welcome. No worries.
Thank you. Thank you very much.
Yes.
How recent is it? Because I know there's other options other than guidance.
Yeah.
Because it seems from what you shared, you're just saying guidance is basically the most halal way. So how recent is it?
Well, yeah, they did say that. It wasn't us. But that study was done in 2014. And that still holds true today.
Even with all the competitive Islamic financing options.
Even with all the options that are out there today, because those were reviewed thoroughly. And I tell you, I remember the review. We actually invited one of our Sharia Supervisory Board scholars to fly to meet with the shuyukh at Amja, to sit with them and to answer their questions for hours at a time. We've been an open book from day one. We just invite people to come and ask. You have access to the details. We've never been the type to be closed off and say, no, you can't. So this made an impact with Amja, a huge impact, because I do want to be honest about this. Prior to 2014, Amja declared guidance haram. But at that point, they had never done that kind of research. And when we approached them and said, listen, you really need to dig deep into what we did here, they were amiable to that type of study. They reached their conclusion. We didn't change one single letter in our contract since 2002. And yet their declaration, alhamdulillah, went from haram to halal, not only halal, the most permissible in the market today. And since then, the competitors have not done anything to really change. Part of the problem, that last 3-minute video, it's very difficult for them to do anything that will truly make them pure because of who their parent company is. If you are a subsidiary of a bank, you are managed legally by the bankers. They actually have to institute a president of the Islamic subsidiary from the bank. The president of these institutions that are claiming to be Islamic are all officers of the bank. They're not Muslims. And the way they operate, one will tell you, oh, no, we just launched a musharaka. Read the fine print. It's very fine, but it states no sharing in natural disasters, no sharing in eminent domain. Why? Because they want to prove to their bank, because they're regulated, that they'll get what they loaned out. They can't share. So this is a major issue. Right. Yeah.
And that's why they can never have ownership to the platform, even in because the law does not allow them to own that property fully and then sell it, or then partner with it. The U.S. law prohibits them. They only allow them in 2 cases. One is the foreclosure. The second one is if they are using it. And that's the only way that they can.
Well, usage is described as, is it your headquarters? Is it your branch? So you may own it if you're operating your business from it, and you may own it for a very short period of time when you're foreclosing on it. Other than that, you're prohibited as a US bank from owning real estate in the United States. And it's very clear. So that's that you could see why we never went that route. You as a Islamic financial institution, you must have ownership. If there is no ownership, clear ownership with your partner, you cannot engage in ijara, murabaha, musharaka. It's kind of silly to say, but it defeats the whole purpose of Islamic finance. You have a question? Do you have a sec? Okay. Do you mind if I take a second question? No, it's okay.
So this one's a little bit more, I guess maybe more on the misconception side, but you did say that there's two monthly fees, the usage fee, which is comparable to what a traditional bank would do, and then there's also like the ownership fee. So like what I've heard from my friends circle is that they end up going with the traditional route because it is cheaper, on a monthly basis. And like if we are saying that the usage fee is comparable to what a bank is, but then there's also an ownership fee, that would kind of like lend truth to the fact that it is more expensive to go this way.
So I want to clarify. You said two monthly payments. It's not. It's actually one monthly payment. So it's one fixed monthly payment, and it's fixed for that term of 30 years or whatever. But the components, the amounts that make up that one fixed monthly payment, are the utilization amount and the acquisition amount. So the acquisition amount is you acquiring. You're just acquiring shares from us. There is no competitiveness to that. It's you acquiring our share. The utilization fee. The utilization fee is what we talked about earlier. Us trying to be competitive with the market by looking at what the national institutions are charging. We're a national player. We're not a local, regional, mom and pop player. This is going to get a little complicated, and I hate to do this to you, but understanding the banking industry. If I'm a bank, I have options galore to sell you money at the lowest rates. Options galore. I can borrow from the Fed window at a very cheap price, and I'm borrowing, and now I'm lending. I can use my deposits that are sitting in bank accounts, which could be hundreds of millions, and I can use them to fuel the loan to you. And because they're my deposits, I can, reduce the interest rate on that loan. And then, of course, I have good old Freddie and Fannie that I can sell to. Now, when I sell to them, their guidelines are strict, things about them are strict. There's a structure, there's a cost. So now, as an institution like us, a non-bank, we've done everything in our power to make sure that when we price fairly. But ultimately, our silent investors, Freddie and Fannie, are going to have a price in mind as well. And we have to try to make sure that they are actually benefiting financially from this transaction to stay in the game with us so we can continue. So every day we do benchmark to the best of our ability to be competitive. Some cases where a local bank has their local funds, they don't have national offices, they can undercut us, no doubt. No doubt. I'm not going to argue that because at the end of the day, we didn't enter the space to be the cheapest home financing company in the country. We're doing it for different reasons, and we want to stay in business to help more and more Muslims. The only way for us to stay in business, because our margins are bigger, our margins are thinner, not bigger, is for us to ensure that everybody gets fully on board with the understanding that if you're going to compare us to national institutions, we're going to be a lot more competitive. Yeah, your Bank of Americas, your Wells Fargos, right? If you compare us to these loan sharks that are sitting around and they offer a variety of exotic products, it's going to be tough. And my thinking is when you move into this decision, it's a major decision to become a homeowner. When you're moving in this decision, when you're moving forward with this, you have to have in your mind, what is your intentions? Your intentions is what? Long-term investment, number one. You want to make sure that you get in the market because values will increase. Number two, you want to make sure that's halal. Ultimately, the roof over your head, over your family's head, you don't want the biggest investment of your lives to actually carry a penny of riba or a dollar of riba. There's no barakah in it. And I don't want to wage war with Allah. So now I have to look at my options and my affordability index. So I have my own ability. Maybe it's not a $1 million home. Maybe it's a $950,000 home. You see? Maybe I go to Starbucks twice a month less and cut my expenses by $50 a month. And that's what we're talking about in these cases. So we're not we're not really talking, oh my God, you're going to pay thousands and thousands more with guidance. That's not the case. I want to clarify that. Yeah, you're welcome. I want to introduce a few folks. Standing right there, that gentleman right here in the middle is Munder Qataish. Munder is our regional manager for the entire West Coast. So Munder is actually a fellow Californian, except he's from Northern California, and he has tremendous experience, and he oversees a large number of licensed account executives for us here in Southern California, Northern California, Washington, Seattle, Oregon. Um, and also, where's Ghada? Oh, there. Ghada is our local account executive here. MashaAllah, she has tremendous amount of experience as well. And she lives locally. So she's here as a resource for all of you to speak with afterwards. And then we have some individuals from the real estate community. In fact, one very special guest of ours is Raghda. Raghda has been in real estate for about 4 or 5 years, but has become, mashallah, the rookie of the year at the Keller Williams office in Corona. And one of the things about Raghda is that she fully understands our structure, understands our market, and has begun to work with us very closely in that territory and other territories. So please see her and ask her any questions about the real estate market in 2023, because there's a lot of people curious, unsure of the real estate market. And people ask this all the time. Hussam, do you think it's the right time? I had a board member of a masjid in Seattle grab me by the arm, pull me aside, and take me to the corner and said, "Man to man, tell me, is it time? Should I move now?" And I said, "Look, are you, if you are seriously considering home ownership, and you're looking at it from a minimum of 3 years, so you're going to be in the home for a minimum of 3 years, I'll always give you this advice. Yesterday was the right time. A minute ago was the right time. It's always the right time, because you are sticking your foot in and claiming a stake in this vast amount of appreciation that happens in the US real estate market. If you're looking to flip, it's a different story, it's more complicated, and so on and so forth. So I will tell all of you, it is ideal, and especially now, Raghda will tell you, because she's on the front lines, seller concessions are on the rise. Seller concessions, which we haven't heard about in the last 2 to 3 years, are on the rise. And you can ask her, because she's getting her buyers excellent deals where sellers are bringing money to the buyer's table to help close the deal. That's actually very, very promising for all of us. And so I just wanted to make sure that I point that out. And we have another gentleman who's actually a real estate agent here locally, Hamid, right? Hamid.
My client asking me, is that a good time? Or should I wait? I said, if you wait and do nothing, you are not going to get anything.
Yeah.
But if you do something and wait, so you get the equity, you get the, as far as the, paying your payment, so you get
Yeah.
something.
Yeah. It's two things. It's equity and appreciation. Think of it two ways. Equity is that ownership that you're constantly acquiring, right? You're increasing your ownership. And appreciation is what? Well, heck, they paved a new highway, the school system's improved, values are going up. Raghda, I don't know if you want to add to that or not, but you've seen probably some pretty good seller deals. Oh. Yep.
So that's
Yeah.
what makes it a great time to buy now, because it's the opposite. We're getting money from, as you can see, also from the sellers to pay the closing costs, and at least you're not competing on the house, you're not raising the price even further.
Yeah.
And of course, they can come back to you and refi it later.
Absolutely. At any point in time, if you get yourself, if you get a footing into the real estate market today, you're going to start building that equity. You're going to start taking advantage of the appreciating value of real estate. And then in a year or 2 years or 3 years, should rates go down, usage profit rates go down, you're always welcome to refinance and lower your monthly payment. That's always an option. So people get hung up on, oh, I'm waiting for the rates to go down. I'm waiting for the rates to do this, to dance, to go left, to go right. I wouldn't wait. I wouldn't wait, honestly. If you're consistent with your belief that you're going to stay in a home for 3 or more years, we urge you to talk to these ladies and this gentleman. I mean, Ghada, you can pre-approve somebody how quickly? Yep. There you go. Yeah. Yeah, to do a double check. But same day is what's possible. Yes. Not alone. I have to correct people when they say you mentioned 30-year fixed loan. The musharaka structure. Yeah. Yep. No, absolutely not. Absolutely. You can pay in the first year. You can buy us out in the first year and there's no penalty. No penalty at all. Well, I mentioned it earlier. Banks used to charge, and some of them are starting to creep back into this habit. They used to charge you a prepayment penalty if you paid off in the first year. So that went away after 2007, 2008. But I'm hearing now that some are bringing that back to hold on to customers a little longer and make their profits and such. So for us, it doesn't exist. It's never existed. We've never had a prepayment penalty on our contracts since 2002. Okay. Well, thank you so much. We appreciate we appreciate your interest in our program, and we're going to be here to answer more questions. And if anybody wants to learn more about how to start this process, we've got some qualified folks here. So, Jazakallah khair. Thank you so much. Assalamu alaikum.